Today's show is sponsored by Pacer ETFs. Over the past year, international stocks outpaced U.S. companies by a significant margin. Now is the time to diversify with international innovators that share the growth and sector dynamics of the NASDAQ 100. The Pacer NASDAQ International Patent Leaders ETF, PATN, targets the 100 non-U.S. companies with the most valuable patent portfolios. That's a tough word. Effectively filtering international exposure through the lens of innovation rather than market capitalization alone. The strategy aims to capture international growth, diversified sector exposure, and access to the alpha generated by international ingenuity. Learn more about PATN at paceretfs.com. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus. A copy may be obtained by visiting www.paceretfs.com. Please read the prospectus carefully before investing. All investing is subject to risk, including the possible loss of principal. Pacer ETFs are distributed by Pacer Financial. Welcome to Animal Spirits with Michael and Ben. It is Tuesday, February 10th. We're recording at 9 in the morning. All right, Future Proof is coming up. I am excited to get the hell out of Dodge. It is cold. It's cold here. It's cold where you are, Ben. You excited for some sun?
I can't wait. The timing of Future Proof conferences are great because September is like the end of the summer. We extend the summer a week or so. Miami in March is great timing because I'm so sick of the weather.
I said at the opening remarks in Huntington Beach that the September event is the start of my fiscal year. That's how I think about. I'm trying to come up with something for Miami. Don't have anything quite yet, but here's what I want to say. The CMO of
you have
Future
two
Proof.
fiscal years. Listen, 2 fiscal years in 1 year, double that. You're living like 3 days in one.
All right, I like it, Ben. All right, Niall, the CMO of Future Proof, tweeted, or LinkedIn or whatever, we've seen more registrations in the past 2 weeks than any 2-week stretch for any Future Proof event ever. Okay? 47% of registered advisors have never attended a Future Proof event before, not a festival, no retreat. It's amazing. So if you want to sign up, hang out with us, fun in the sun. The dates are March 8th to the 11th.
Yep.
Come hang out. It's going to be a great time.
And you have to sign up if you want to be part of the breakthrough meetings, which a lot of people say that's their best thing they get out of it.
That's the sauce.
Is the one-on-one breakthrough. So you have to sign up for that. The deadline is Friday, November 13th.
Okay.
Friday the 13th this week?
November 13th.
Sorry, February 13th.
So Ben is under the weather. So him completely going to the other side of the calendar, you're forgiven, Ben.
My brain is broken. Sign up on Friday if you want to get the breakthroughs.
I am talking with Matt Middleton, founder and CEO of Future Proof, on Wednesday on the Talking Wealth feed, where we go all over the RIA spectrum, the wealth management spectrum. So we're going to peel back the curtain, so to speak. So that's Wednesday at 11. All right, we have another busy show as a result of what we opened the show with last week. Man, things are changing. News is news, and we've got 46 pages to get to, so let's get right to it. All right, tail of the tape of the stock market from last week. This comes from Duality Research. The S&P, basically unchanged. Boring week. Fell 10 basis points. Nothing
you
to
didn't
see
pay
here.
attention to the headlines or the underlying what's going on with the stocks or the precious metals or the crypto. You looked at that and you go, nothing happened this week.
Yeah. I'm sure there was memes made about index investors yawning.
This is the crazy thing, though. The average stock last week was up almost 2%. 337 stocks outperformed the index last week.
Wild.
And because all we hear about is, this is crashing, that's crashing, this is going nuts. And this really seems to be the year where it's like it's turning. The other stuff is working.
It's turning.
Everything.
I had Matt go into the lab last week. I said, hey, dude, this feels weird. Like there's a lot of bright red on the screen, and yet the index is near an all-time high. So let's look at some of the data. How often does this happen? And what we came away with was on Thursday at the close, there were 107 stocks over the previous 2-day period that fell 4% on an individual day. Okay. So not they fell 4% over a 2-day period. There was 107 stocks that fell 4% over a single session. That's a lot.
Yeah.
When that has happened historically, the index was in a 28% drawdown.
Jeez.
Right now, or when that happened, the index was 1.5% off its highs.
We're basically within
Very,
spitting distance of an all-time high again. The
very bizarre
equal
scenario.
weight hit all-time highs last week. Small caps are at all-time highs. S&P is basically there. This is another one from Duality. Every year, I feel like someone says it's going to be a stock picker's market this year. This actually is. 66% of S&P 500 companies are outperforming this year. Whatever, we're 1 month in.
It's great.
But still, this is a total sea change from what it's been like. The Mag 7 has gone nowhere for like 6 months, basically since September.
Wait, hold on. People can't see this chart. So within the S&P 500, Duality Research broke it down by sector and asked how many stocks are outperforming within each sector. Every material stock is outperforming the S&P 500.
That's pretty nuts.
96% of energy stocks, 92% of staples.
Consumer staples are going nuts too, yeah.
86% of industrials and 77% of utilities. So finally, there was a bit of a reprieve from the, my God, with the Mag 7, just let me in. Give me a chance.
So explain to me the staples thing, because this is, to me, the one that like sticks out the most for doesn't make sense. Why are consumer staple stocks going so nuts?
That's a great question.
Sorry, go ahead.
I would make up two reasons. Number one, it's sentiment. Like the rush out of previous leaders into previous laggards, some of the high flyers into some safety. I guess staples are the anti-AI trade would be number one. And then number two, there has been a fundamental re-rating in some of these names that are maybe the beneficiary. I don't want to say that Coca-Cola is benefiting from AI. That sounds kind of absurd. But I don't know. Maybe I'm just making that up. I
just put this in here. Ed Elson tweeted this yesterday. Walmart's PE is 46 times. Costco 54 times. This is kind of crazy that we're seeing these valuations for these stocks in this market.
So those valuations on Costco in particular, that's not new news. But what is new news?
Walmart, right?
What is new news is the forward PE of tech and staples are basically at parity, which is wild.
Whoa, that is crazy. Huh.
Yeah.
Okay, so yeah, the Mag 7, I pulled this out. This is the Roundhill has a Mag 7 ETF, and it's gone nowhere. I mean, whatever, it's 6 months or something, but still, in the midst of the supposed AI bubble, it's not going anywhere. Hang on, I can take out this Mike Zaccardi. Oh, here's a Mike Zaccardi one that kind of lines up the Duality. So 60% of stocks are outpacing the index, but it's been 35% in the previous 3 years. So this really is a totally different market environment we're in right now.
Mm-hmm.
Like a lot of other stocks are doing well. What does JC like to say? It's not a stock market; it's a market of
stocks. That's right.
Okay, so I pulled out. I had Chart. Can Matt make this for me? I just picked a bunch of household names. How are they doing? And this is through Friday. Netflix and Robinhood and Disney and UPS and Target and Coinbase and Nike and all these stocks are down anywhere from 40 to 70%. Estee Lauder is down 73%.
Can I make a chart gestion?
Yes.
This is beautiful, but would really bring it to life.
Okay.
What would really tie the chart together is if instead of the names, you had the logos.
Ah, I like that.
Right? That it just pops.
Giving Matt more, yeah. So the S&P again is almost at all-time highs. It was 66 basis points off on Friday. And all these other stocks are down 40, 50, 60, sometimes 70% in some cases.
I think we buried the lead. We'll get to this in a minute, but it's the software unwind. It's the software / momentum unwind. We'll get to that in a second.
But it's also a lot of brand names. And I think sometimes it feels like you feel like you're kicking people when they're down if they are in some of these stocks. But I think you have to remind people of the concentration risk, because when these things are going crazy and going up, we talk about that too. So I think it's just worth reminding people how concentration works both ways. Because I think there's a lot more concentrated investors now than ever. Would you say that's accurate?
Well, when you say concentrated, are you talking about concentration within the index, or meaning like people that own outsized positions in the names?
People who own a handful of stocks.
Yeah.
2, 3, 5 stocks, and that's it, because they've worked so well. And why would I own anything else but these?
Yeah, but yes.
And it's probably in a brokerage account, maybe not the whole portfolio.
The only stock that people own in size that is crashing is Microsoft. I don't think there are not a lot of people that are loaded up on Workday or ServiceNow, except if you're an employee there. And even Microsoft, just anecdotally, I would say, is from what we see, the least owned Mag 7 name.
Okay, how about this? So I've talked to Joey Fishman is our sort of in-house expert at Ritholtz on employee stock option plans and RSUs. And he's saying like the conversations are so much different these days because in the past it was, why would I ever sell out of my company stock?
Mm,
So people who are with these companies and have these stocks, they're the ones who are having challenging conversations and decisions of, holy crap, my stock options. Now what?
correct. All right. So for the last 10 years, the S&P has been the winner, right? Above everything else. And the Dow has just been like, the Dow has taken a backseat. Nobody cares about the Dow Jones, the sleepy industrials. I thought this was a great chart from S&P Dow Jones showing the constituents' average tenure, meaning how long is a company in the index before it's booted. And this peaked in the mid 80s at 45 years, and it's come down steadily since then. But still, the average tenure is 25 years, okay? So once you're in, you're basically in, unless you're Exxon and you get kicked out when oil goes negative. Which, by the way, Josh traded with us. Ooh, that was a rough swap. They kicked out Exxon for Salesforce.
And that was
I
what,
think
3 or 4 years ago, probably?
Holy mackerel. I think that was 2020.
Oh.
All right, whatever. Point is this. Last week on Friday, DIA, which is an ETF that we almost never talk about, led all flows. This is from Balchunas.
Wow.
This index is equivalent of a rotary phone, price weighted, invented when Grover Cleveland was POTUS, but it could be perfectly situated for 2026 equity rotations. So to that point, last week,
This boggles my mind. I had no idea this was the case. People are still allocating to the Dow.
Oh yeah. I'm gonna guess there's $40 billion in that thing.
So it
What do
has
you think,
44
over,
billion.
under?
Yeah, it's 44 billion. I was just looking.
Ooh, credit to me.
That was pretty good.
Okay. So Alex Semenova.
So as a percentage of the total AUM, that's a massive number going into this fund. Because all these other funds are way bigger, probably. VOO and such.
Wow. Yeah. Okay. Alex Semenova tweeted today, value over growth posted the third largest one-day outperformance ever. And then Bespoke zoomed out a little bit. Value versus growth was in the 99th percentile of outperformance over the last 6 days.
So we've been asking, like, when is this whole thing going to change? What we've been talking about for feels like forever now. We're in the midst of a sea change. It feels like.
Credit to Chart Kid. I don't know if I asked him to make this or whatever. Maybe it was my idea. Maybe it was his idea. Who knows? We share ideas. 4 weeks ago on What Are Your Thoughts? I had a chart of the Russell 2000 divided by SPY on the bottom pane, breaking out. And we had the Mag 7 divided by the 493 breaking down. And that has since severely accelerated, which is exciting, right? The last couple of years have been kind of boring. It's like been the same talking point over and over again.
Yeah, so, last year was the start of it with international stocks, but now it's small caps and mid caps and micro caps and value stocks and consumer staples and high quality. All this stuff is finally working.
This is all Matt. He made a chart on Friday showing the spread in the equal weight versus the cap weight S&P through February, whatever, is like the largest spread maybe in history. I forget what the exact stat was, but it's extreme. All right. On Friday, we got a big bounce back in the most shorted stocks. They jumped 8.8% on Friday. Kevin Gordon tweeted, best day since April 2025.
Because I'm sure they were getting killed before then, in the few days leading up to that.
So Josh and I have spoken a lot lately, a lot about not catching falling knives. Although let me be very clear with my words. I have tried a million times and beat my head against the wall about trying to buy stocks that are in not falling knives per se, but downtrends, like severe downtrends, and thinking that, you let it stabilize, not just guessing, but like let it, even when you let it stabilize, it's still difficult.
I'm a knife catcher. You always want to wait for it to turn back up.
Well, so you could have an asset class or a stock that's trending lower, and then it just sort of bottoms, right? And it goes sideways for 3 months. And to me, that is an indication of sellers drying up. I used Intel as an example last year. I didn't buy it, But I said to Josh, and what are your thoughts? Like, there's no more sellers, right? Like, the stock is down 70% and it's gone sideways for the last 4 months. It's stabilized.
I don't know what it is about psychologically for me. Dollar cost averaging into a losing name feels better than dollar cost averaging into a winning name. It's backwards of what you should do.
It's backwards of what you should do. So anyway, I don't do it. I don't do that. I do not dollar cost average into a falling knife. I don't into a stock that's going down. Excuse me. All right. But when there is a stock like Microsoft or a basket of stocks like software stocks that are going down, right? And then there is a puke, a panic, a liquidation where you see it in the volume. That's the type of thing that I buy. And it's not to say that like software stocks bottomed last Thursday. So I bought IGV last Thursday. And initially I bought it for a trade. So my intention was, think about like a buoy, right? Something that like floats, where it's just been held underwater for so long and just pushed all the way down. It's going to pop back up. All that you don't even need buyers to step in. You just need sellers to chill out. And when there is a panic like there was on Thursday in a basket of stocks like that, that's the type of thing that I buy. No questions asked.
You timed it pretty good. So the
Well,
IGV
hold
was
on.
down,
I'm not taking victory lap. It's not always right.
No,
but when I
so
see like a panic like that, I have to buy.
it was down 33% over the course of, I don't know, 4 months. So we got to talk about why this is happening. So Wall Street Journal had an article basically saying like Anthropic tanked the software market. Like Anthropic came out with Claude Code, Claude agents, all this stuff. And people go, whoa, is this totally changing what is going to happen in the software stock market? And my take on this is people finally waking up to the potential of, what if the AI bubble doesn't pop? Like, what if AI just works right away and we get more productivity? And yeah, sure, there's losers, right? Remember at first it was Microsoft and OpenAI are the winners. Now it feels like Google and Anthropic are the winners. I don't know if that'll change or not. But there's going to be losers, of course. But what if like this AI stuff is working and it actually disrupts this technology field? And so Salesforce sold off and all these other software companies, and IGV, yeah, was down 33%. Microsoft was down 25% or so. And obviously it feels like there is a huge overreaction here. But I would not want to try to jump in and make like a pounding the table on this, because what if, I said this to you and Josh this morning, what if it's just these software, yes, people aren't going to just code in their own stuff in AI and totally get rid of their CRM system. Like that to me seems like a stretch. But
yes,
could these stocks be re-rated forever because of this? I think that's a possibility. Like, because their moat has been damaged in some ways. That's what would worry me about diving into these names for being a long-term investor.
Okay, so just to return to the trading example, for the few of you who are interested in this. So Adobe, the stock was already down 50%, 60, whatever it was. Adobe peaked at 630, okay, or 640 in February 2024. And the stock got as low as 315. All right, so the stock was cut in half. So Josh and I were talking about the stock. It had gone sideways. Buyers were stepping in at 330. We tried to take a stab at it. The stock bounced and then rolled over violently. And we both sold. I took a 3 or 4% loss. No big deal. The stock sold off violently from 330 down to 263. So when you're fighting the tide, the market is usually right. The market is not 100% right 100% of the time. But when a stock is down 50% and you're just blindly trying to buy it, you're probably going to be wrong.
And this stock hasn't bounced at all. A lot of stuff bounced on Friday. Adobe has not.
Adobe has not bounced. So that's why, like, my working assumption when I buy names like this is I'm wrong and I keep a tight stop, right? Maybe you get a 20, maybe you're right. But like, anyway, last week we were so busy, not to belabor the point, with news that we forgot to mention a huge piece of news. So yes, last week was the story morphed from the Anthropic law program to, oh my God, like vibe coding is serious. All of these enterprise SaaS names are like in deep trouble. Maybe not today, but in 3 years, their margins are dead. Like the growth is gone. And we're just going to kill the stocks and we're overreacting. Fine. Okay. But prior to that, the week before, when Microsoft reported, which did we even talk about Microsoft last episode?
No, so much stuff is crashing. We missed it.
Okay, so from Bloomberg, Microsoft shares got caught up in a sell-off Thursday that wiped out $357 billion in value, the second largest for a single session in stock market history. The software giant stock closed down 10%, its biggest plunge since March 2020. The only bigger market cap loss was NVIDIA on the DeepSeek sell-off. So this has been going on for months and weeks. And yeah, last week it was like, okay, what's happening with software? What's the future of software? And investors don't know. The people at these companies don't know. The venture people don't know. The futurists don't know. Like nobody knows.
No, but I think the overreaction to me makes sense.
Totally.
But here's the thing that's going to happen though. Whether these companies are impacted forever, like I imagine these companies, most of them will probably be okay.
Well, it depends which companies you're talking about.
Well, true. I'm lumping them in, but even if they are, like, there's going to be huge layoffs in these companies. They can't continue to give stock options to their employees. Like, if you worked in one of these companies, you would have to be very nervous right now. There's going to be huge layoff, and this is one of those things where there are going to be layoffs because of AI that people are going to think this is a recessionary indicator, and it's not. It's going to be this AI is going to break economic indicators of the past. There's going to be software layoffs because of this productivity tool, and people are going to go, right?
Square, now called Block, Jack Dorsey's company, is laying off 10% of their workforce. All right, so PitchBook had a really good take, I think, on these names. Replacing a core SaaS platform effectively is open heart surgery for an enterprise, entailing immense operational friction. It's far easier to add an AI copilot to existing operations than to fully migrate to an AI startup. I think that's totally true.
Yes,
and I also think that the overreaction makes sense too. Yes. So here's Ben Thompson. Ben, I'll read this since you're on
he's been all over this. His podcast on Friday was all about software and it was excellent. Totally worth a listen if you're a subscriber.
So Ben Thompson writes a Substack called Stratechery. I think you and I have been known to say Techery.
Yeah.
I'm not quite sure why.
Strategery.
That's like when Baba Booey said McKine, which you're not a Howard Stern fan, but for those of you who are listening, you'll understand. All right, here's what Ben Thompson said. The beauty of AI writing code is that it is a nearly perfect match of probabilistic inputs and deterministic outputs. The code needs to actually run, and that running code can be tested and debugged. Given this match, I do think it is only a matter of time before the vast majority of software is written by AI, even if the role of the software architect remains important for a bit longer. That then raises the most obvious bear case for any software company. Why pay for software when you could just ask AI to write your own application perfectly suited to your needs? Is software going to be a total commodity and a non-viable business model in the future? That's what investors are asking today. All right, back to Ben. I'm skeptical for a number of reasons. First, companies, particularly American ones, are very good at focusing on their core competency. And for most companies in the world, that isn't software. There is a reason most companies pay other companies for software, and the most fundamental reason to do so won't change with AI. Second, writing the original app is just the beginning. There's maintenance, there are security patches, there are new features. These are changing standards. Writing an app is a commitment to a never-ending journey, a journey to return to point one that has nothing to do with the company's core competency. And third, selling software isn't just about selling code. There is support. There are integrations with other software. There's compliance. The list of what is actually valuable goes far beyond code. This is why companies don't run purely open source software. They don't want code. They want a product with everything that entails. Still, that doesn't mean the code isn't being written by AI. It's the software companies themselves that will be the biggest beneficiaries of end users of AI writing for code. In other words, on this narrow question of AI written code, I would contend that software companies are not losers, but rather winners. They'll be able to write more code more efficiently and quickly. All
Well, I
right.
mean,
And then,
do you think we would give up on our CRM system and let like some vibe coding 25-year-old write it for us?
no,
Of course not.
we're a regulated company.
Yeah, the compliance. But I think the point is that the moat has been damaged here, and like there's going to be software companies that spring up that don't need as many employees that can have AI write the code and have someone oversee it. And that's the big thing is the moat has taken a massive hit.
Exactly. Exactly. And then Ben concludes with the problem, not this Ben Thompson. The problem now, however, is that while businesses may not give up on software, they don't necessarily want to buy more. If anything, they need to cut their spending so they have more money for their own tokens. That means the growth story for all of these companies in serious question. The industry-wide re-rating seems completely justified to me. And I could not agree more. So, for example, a company like Salesforce that we work with and we have worked with for a decade. Guess what they do every year? They raise their fees. And they can't imagine that we're a one-off. We're not a very unique business. That's over.
Right.
How about we just say, you know what? No. Right? And we negotiate, right? But like we only have so much leverage. And so, yeah, the re-rating both makes sense in the long term and simultaneously can be overdone in the short term.
Yes.
I think that's where I'm at.
And whatever, one or two of these stocks is going to look like an amazing long-term deal after all this. And a bunch of them are going to look like dogs. That'd be my takeaway.
All right. So I have been a relative defender, I would say, to some of the private credit stuff. I think I've been pretty fair.
You've been trying to get people off of like the just going crazy because they hate it and it's going to be a crash. And yes, I agree with that.
Like, so a lot of the cockroach stuff, my take was like, listen, sometimes loans go bad. Sometimes there's fraud. It's not, and it's not just in private markets. Okay. This is tricky for private credit because a lot of the businesses that they lend money to are SaaS businesses. Why? These are recurring revenue. This is predictable. It's easy to model. Okay. Wall Street Journal, private investment firms have piled into the software industry in recent years. At the end of last year, almost 9% of private equity-backed companies were in the software space. The exposure is even more significant on the loan side. Within the private credit universe, the firm classifies, this is KBRA, about 17% of borrowers as software companies, representing about 22% of the $1 trillion plus debt exposure in that universe overall. Yikes. So I spoke to one company yesterday in this universe, and I said, what's the duration of these loans? And they said, for us, it's 4 to 5 years. And I went, all right, so all the publicly traded BDCs just murdered last week.
Absolutely destroyed.
ARCC, which is the Ares Business Development Corp. And this is basically liquid private credit. And it's the biggest one. I think it's 15 billion, something like that. So right on their website, software and services. Now, I don't know how much of this is horizontal, SaaS companies, which is really in the eye of the storm. How much is vertical, which I suspect will fare a little bit better. But it's 24% of the portfolio. Yikes.
So investors are obviously selling down not just the BDCs, but like the private equity managers. So Blue Owl is down 50%. That's not a surprise. But Blackstone, KKR, Apollo are all down, 30%. These are getting hammered too.
So to me, like Blackstone is a screaming buy. I don't own it. But I think like that is way overdone.
Okay, because they're bigger and more diverse than...
I have to say it, not investment advice. So Blackstone getting caught up in the software stuff, I mean, like, I get it. I get why investors are doing that. But come on, this is the biggest winner, and what my estimation is going to be a secular trend. All right,
I know it's not fun to see things crash because that people own these things, and especially people who work at these companies. Like that's got to be a lot of turmoil. I think the most interesting thing about the AI from a market's perspective is this reshuffling of deck chairs. And every month,
exciting.
Every couple months, it's like, oh my gosh, over here now. No, wait, over here.
It's very exciting.
It's one of the more fun parts about this market, I would say, watching this stuff happen in real time.
All right, so we mentioned like there's horizontal software companies where there's a piece of software that serves a lot of different industries. So there's no real specialization. Salesforce, for example, right? Like they work with financial services, and I'm sure they work with every other industry in the world, as opposed to a company that only works in one vertical. So I pulled this. Where did I pull this from? I think this is from PitchBook again. PitchBook is all over this trend, by the way. So they were talking about investor sell on software private credit loans. All right, a spokesman for a New York City parking garage company, GMC, explained that the company had recently ended a multi-year contract with a parking garage management software provider after it stopped providing certain features. Instead, GMC hired a programmer to develop a bespoke system that will organize the company's New York City valet parking garages more efficiently. Quote, now we won't be subject to another company's price hikes. They have all the leverage that they know the customers really rely on it. PitchBook goes on to say, but it certainly won't work for all. A media company executive said there was, quote, no chance of canceling the content management software system it used, adding that alarms about the death of software were overblown.
That's a good both sides thing, right?
Yeah.
Last week, I asked, like, what stops this train? What stops the margins from rising so much? And it seems like the hyperscalers are going to try to test this theory. So another Mike Zaccardi tweet via Bank of America, hyperscalers CapEx as a percentage of operating cash flow was 65% in 2025, expected to be as high as 90% in 2026. It was 40% from 2017 to 2023. So they are really going for it. And maybe the market pushes back, but you don't believe this?
There's no way. There is no way that investors will allow 90% of the operating cash flow to be spent on CapEx.
That would be my thinking too.
The stocks will crash.
But they're saying this is in 2026. This is right now. This is going to happen this year. So look at the numbers that they've said in their, like, listen, their expectations. But this is from Matt Vincent on Twitter. He said $314 billion of incremental CapEx spend in 2026 on top of what they've already done from the big five, and that's Amazon, Google, Microsoft, Meta, and Oracle. That's 1 percentage point of GDP growth and more than 2% of total US GDP from 5 companies in spending. These numbers are astronomically high. So to your point, when do investors say enough? No, enough.
I mean, I guess they're kind of already saying that. Microsoft's down 25%.
So this is like a quick, like, snap your fingers 10% correction in the market when one of these companies goes, all right, you got us. We're pulling back. Right? Isn't that it? Isn't that like the fastest correction ever?
You know the Cranston meme?
Yeah.
But I don't know how the market will respond to a pullback of CapEx.
Or do you think they'll be looked at positively? Like, okay, great. I really don't know.
I don't know either.
But these numbers this is why the AI bubble stuff is so hard to wrap your head around. Like, because these numbers just seem so ridiculous. But then you see the stuff that's happening and you go, well, maybe it's not ridiculous. Because this productivity is gonna happen.
This is a great tweet from Buco Capital. Jassy was too slow to invest in CapEx and got a wedgie from investors who said, more CapEx, you loser. So he said, fine, want to see CapEx? I'll show you CapEx, but now everyone hates it. So, all right, CapEx for Amazon. 2025 was 130 billion. They're guiding to 200 billion, by far the highest of the Mag 7. 200 billion? What? How? How do you spend $200 billion?
It is kind of crazy that they're even higher than Meta and Microsoft and Google. And
okay, now think about it from this point of view. The output of all of this spend is going to be so insane. Remember the video we showed last week of Henry the bot? Like, think about what's coming. I think we're like so deep in the stock price and the numbers that we're like, think about what's coming. And this is why, all right, zooming out, like, I think it's hard to get too bearish on the stock market overall.
But well, the question is, but what is all these cool tools? How does it actually help the bottom line? That, like, I get it. Meta is going to give more ads, but that's the thing. Like, how does it actually make more money for these companies? That's the hard part.
Well, I'm sure they know what they're doing.
Do they?
Famous last words.
Yeah.
Yeah, dude, I'm sure there is a plan. They're not idiots. They're not spending the most money in the history of the world because they just like lighting money on fire. These are not dumb people. And if you're making a face like they are, come on.
Zuckerberg did the metaverse. They literally changed the name of the company. These people are not always right.
Okay, that was pretty dumb. You do have me there. But they're all.
Yo, you're right. We're gonna get some cool stuff out of this. I just want Scarlett Johansson in my ear. That's all I want. Make it happen. Hey,
So,
take
all right, but
all my emails and do
my
no.
bigger picture amongst the software crash, amongst the re-rating of the momentum trade and whatever. We've got a new Fed chair coming in who's going to cut. The consumer is fine. There is giga gaga capex money being spent. Like the market's going to be just fine. And I hate to say that out loud because I'm making this up just like everybody else is. But I guess I would just say, like, if you're like nervous right now and like, like the market's about to fall out of bed, I don't see it. It could be wrong, of course.
The market is broadening out.
Well, there's that. I mean, thank you. That's the key point.
Right.
Yeah.
Like that's if this other
you don't see that at market tops.
If you saw all this stuff not working still, then I think you'd be rightful to worry about stuff.
If the rest of the market was rolling over, I've said this a million times, if the rest of the market was rolling over before the AI stocks did, I would not be saying this. I would be getting nervous.
And this is the money thing too. So Gunjan from the Wall Street Journal. Wild inflows to sectors outside of tech this year. Sector funds, excluding tech, have seen a record $62 billion in inflows in the first 5 weeks of the year. To put that into context, that's more than they saw in all of 2025.
Are you kidding me?
So the money is also, it's not just the performance of these things, like, hey, they're bouncing. Investors are taking notice and they're diversifying.
Yeah, so when you asked me earlier in the show, like, why are staples mooning? It's flows.
Yes, money is going into them.
I thought this was kind of interesting. There's an ETF XMAG, which, by the way, credit to them for being early. There will be more popping up. This is the only 493 ETF that I could find.
That was
And
smart.
assets are, I mean, it's not a lot. It's 125 million, but it was like nothing until the flows have only really just started to come in.
And they've taken off like a rocket ship in the last 3 months.
Yeah.
Holy cow. All right.
Another one. Market check, Ben. It's 9:45 on the East Coast.
Okay.
Oh, S&P's flat. Equal weight's up 23 basis points. The beat goes on, Ben.
All right. Small caps up a little bit. All right. So last week I talked about like what is the case for EM? Like why would EM and international stocks keep outperforming? And this is from The Economist. Why the dollar may have further to fall. And it talks a lot about like the safe haven status. And I think the dollar is down 12% from the highs or something. It says 17 years ago, debt securities held by foreign governments and central banks accounted for 38% of all portfolios investment into America. Today, it's 13%, the lowest level in modern history. So like the overseas, they're not owning as many treasury bonds like that, and that impacts the dollar. And it says like there's no rival asset that looks ready to supplant the dollar's reserve currency. Like, and I totally agree with that. But demand for greenbacks can ebb and meaningfully flow without any serious challenger emerging. So it says the ongoing erosion of America's safe haven status, together with uncertainty over policy and independence of the central bank, mean the dollar's appeal increasingly rests on the ability of American assets to outperform the rest of the world. That is a precarious base on which to build investor loyalty. So it's saying like the dollar could just cyclically, doesn't mean the dollar has to crash and go away forever and lose its global reserve currency status. But we could be in a cycle of that, and that's the bull case for emerging markets last week that we didn't talk about.
I'm looking at a ratio chart of IFA divided by VTI, so international developed divided by US. Whew, man, this looks like a bottom. Like it looks like a real bottom. And there's been a lot of false starts over the years. Could be the one.
Could be happening. It could be happening. And or two years, this is a blip, but yeah, who knows? My mind is blown. We asked for years, what would be the catalyst for this? What could possibly make this happen?
And it wasn't like a rhetorical. Like we were serious. It was like, I can't. What could have? What? How?
And so we have a talk your book coming up in the coming weeks with Invesco about real assets. And the point made on that show was, listen, part of the AI build out means we need more stuff. We need more energy. We need more physical labor. We need more data set. Like we're building out all this stuff. That's like bullish for all these other countries still with the materials and the industrials. And it's interesting. All right, let's talk about AI.
Wait, hold on. Ben, look at this chart.
Okay. So it like you said, it flatlined for a number of months there, and then now it's taken off. Is that what you're looking at?
It puked, recovered, went sideways, and is now accelerating very hard. This looks real.
It does. Okay. Kai Wu had a new piece out. You read it, I assume? I read it?
I did.
Okay.
Kai Wu
Brooklyn
is one of the most interesting white paper writers. Now he's more than that. He manages an ETF company. He's a very smart guy, but he does white papers.
He's usually at our Future Proof conferences too. He might be there.
Yeah, he'll be there. He does like 2 or 3 a year, and every time he looks at things differently because he's like a machine learning smart dork who puts all this stuff together. So he has a chart showing companies mentioning AI-driven ROI, which has gone from nowhere up to 7%. And he's pulling this from earnings transcripts. And then he's also got a chart showing companies mentioning AI-driven economic gains, which has gone to 32%. So, but think about it like this. Only 7% of companies are talking about an ROI that they're getting from all of these, the CapEx spending that on the hyperscalers. Do you think that's going to 30%?
That's possible. And he also looks at like a lot of the winners here. Like what are the companies that are benefiting from this? And I pulled out one he didn't mention. Look at the chart for C.H. Robinson. I mentioned this one on the show a couple months ago. I put it in here right below his charts here. Look at
what does this company
Robinson.
do?
This is a logistics company. I think I mentioned on the show, unless I mentioned to you, just a phone call. I had a friend who worked here, and so I know about it. And it's a trucking logistics company that is using AI to make it faster to match drivers with trucks. Look at this chart. Parabolic. It looks like the silver chart.
Okay.
They're using AI to make their company more efficient to match drivers and trucks and shipments around the country.
This is so good.
Right?
What a great example. So in the previous lines that I mentioned, in the previous chart, he has another one that shows, all right, so those companies that are talking about AI-driven ROIs have beaten the market by 5 percentage points a year. The companies that I've mentioned in AI-driven economic gains are beating the market by 4.8% a year.
That's a great chart, because a lot of times you say, okay, sure, they'll say anything in their earnings calls, but does it actually translate? So this is showing like what people are saying actually is translating into economic gains. It's not like it's not just fluff from company management.
It's hitting the bottom lines.
Right.
And I don't have this chart in here, but there's a chart of S&P 600 earnings estimates, and they're skyrocketing. There is a reason why small caps are catching a bid. And I don't know that it's all productivity, but I'm sure it's a part of it. All right, here's one part of artificial intelligence that I don't love. Google now has suggested responses built into Gmail.
I don't like them either.
And they're good enough that, and I'm sure that they're going to get better. I just don't like the idea of this. So for example, this is a suggested response in our inbox. Hey, Joe, Knicks win was huge. For 3+ years, it was somebody asking about like, what do I do with my house money? Right? I'm buying a house in 3 years. I don't know if I just want it to sit in cash, but what do I do? Hey, Joe, Knicks win was huge. For 3+ years, I probably lean short duration bond funds or just keep it in a high yield savings account. Volatility is the enemy for a known future expense, Michael. Now, I would hope that somebody's going to know that that's a fake email. By the way, I did not send that email. I just don't like this idea.
What, you wouldn't send the cookie, the Chinese fortune cookie at the end there?
Yeah, volatility
is the enemy of a known future. That's so bad.
If you ever see me doing that's not me. I accidentally hit send by accident on the suggested reply.
So you talked me into Claude a little bit last week, and YCharts has the ability to do these comp tables where you can take an index or a group of stocks or a fund and break them out into all these different categories and variables. So I just took year-to-date gains in every S&P 500 company. I downloaded the spreadsheet. So it takes what has it done so far this year? And I put it into Claude and I said, tell me what's going on in the market. And it spit this out in, 60 seconds. It says industrials are on fire, chemicals are having a moment, consumer staples rotation. Hershey is up 27%. Food names, even airlines showing surprising strength. Defensive characteristics plus pricing power equals working. And then it talks about like tech carnage deep in, and we'll show this in the YouTube if anyone wants to see it. Fintech collapse. Here's the bottom line, which I thought was really good. The market is experiencing an aggressive rotation from high multiple growth into tangible capital intensive businesses. And it says that's equipment, logistics, chemicals, semiconductors, consumer staples. This looks like a classic late cycle value rotation. Investors fleeing expensive momentum-driven names for businesses with physical assets, pricing power, and operating leverage. Like this is really good.
That part that you just mentioned, this looks like a late cycle thing. If I was to like have one thing that's like how did I miss it? Right? Earlier in the show, I said, like, I like the setup. If there was one thing that I would point to that said, oh, you dumb, bald idiot, it would be this dynamic.
Yeah. Yep. It's kind of funny that Claude pulled that out.
But I just think, I don't know, late cycle, it hasn't even started.
That's the hard part. But the .com stuff, I know this is different than that. We had to go through the .com blow up to get everything that the internet promised.
Maybe it's exactly the same.
I don't know. I thought this was pretty good. I think one of the most ironic things that we're talking about is the fact that the AI boom so far is probably going to disrupt tech more than anything at the begining, right?
Yes.
From the start, tech is the biggest industry. They're disrupting themselves.
They like accidentally like turned the gun on their face.
So Adam Ozimek has a Substack, and he wrote this really long piece about like how the human touch stays through all these technological developments. And I thought he said there's still 67,000 travel agents, which is crazy to me, despite the fact that there's widespread leisure hospitality and stuff online. Self-checkout has failed to replace 3.2 million cashiers and 4.2 million retail sales workers. I remember Scott Galloway, when he came to speak at one of our very first conferences, said, what's going to happen when you don't need cashiers anymore? There's 3 million people displaced. They're still working. And he's saying like part of it is just people want a human touch when they have an interaction for a transaction. Not always. But that's the thing that's going to be hard to map out with all this, is how much are people going to still require the human touch?
You know, we're going to be, this is the topic for the next 10 years of our career.
Oh yeah. For sure. Like, yeah, this isn't like going away quickly. You're right.
All right, crypto. Last week, Bitcoin was at 78,000. I can't remember in what context, but I said, I have no interest in buying it right now. Right? It's just like bleeding and there's no whatever.
And then just a massive puke.
So I bought it on Thursday. I actually bought IBIT. I've never bought the ETF before. Again, this is not investment advice, and it's acting like dog shit. It's barely bouncing. I'm probably going to dump it.
Bitcoin's getting smoked again today.
It's at, I bought at 66 and went down to 60. It's at 68. Here's what's going on in Bitcoin. Alexandra Semenova tweeted, IGV and Bitcoin look like twins. I mean, they are moving in lockstep.
This chart is a tough look for Bitcoin.
Yeah, it's acting like the broader tech world. All right. Somebody tweeted, when I said things will get ugly, this is what I feared. Maybe the worst sentiment I've ever seen to BH. The good news is this means opportunities are near and the Taurus are whatever. Okay, so Nick Majuli quote tweeted it and said, I've now seen multiple big crypto accounts saying this is the worst sentiment they've ever seen. And we aren't even in a recession. Can't imagine what would be happening if stocks were crashing too. Very good point. My God.
Yes.
That's
right. Like the Homer Simpson meme. No, this is the worst sentiment yet.
Correct. So last week, again, when I said I wasn't interested in buying it, I really wasn't. But then it crashed, and look at this chart. So you see put volume spiking. You see volume number of shares spiking. So like you saw a physical get me out liquidation, and I buy that all day long. I just do, right? That's right in my wheelhouse. It hasn't worked yet. And if it rolls over, I'll just sell it. And if it bounces to 72, I'll probably sell it too.
So this is, you remember the player haters ball from Chappelle Show? I don't know if you were a big Chappelle Show watcher. Oh man, we went on spring break one year in college. My senior year of college, we went to somewhere in Mexico, and there was a big bus that picked us up from the airport, all these college kids at one resort. And Chappelle Show was just huge at that point. And people were doing the Little John the whole way there.
What? Which one?
Just,
yeah.
Yeah. Pretty bad. But anyway, remember the player haters ball? They had Ice-T in there. The last couple weeks has been the player haters ball for crypto. If you were a person who wanted to dunk on crypto, you've been doing it incessantly. I've been seeing a lot of people and this is I feel like crypto more than anywhere else is dunking when things are up if you're owning it, and dunking when things are down if you don't own it or hate it. It's more than any other asset class.
It is the ultimate lightning rod. So last week on TCAF, which was awesome, by the way, we had a new guest on, John Mowry, who's phenomenal. He asked me, because we were talking about crypto, I said I just bought it today. And I think he asked me how much of it I owned. And I don't know why I didn't divulge, but I guess it was just live and I wasn't, whatever. So before the recent sell-off, I sold it down to 5% of my liquid net worth. All right, so whatever. That's where I was. It's now smaller, obviously, since it's gone down so much. But I bought, again, the the 66,000 that I bought, that's not like I'm not adding to my holdings. Like I'm gonna sell it if
That's
it
probably
bounces.
where I am too. I'm probably like 4 to 5%. And for me, it was up to like 10%. And that's what got me nervous and why I sold some because it
I
was way
was
too
say-
high of percentage.
I was significantly higher, and I said like, whoa. You know the scene in Old School when Will Ferrell is on stage, he's like, I blacked out. What did I say?
Yeah.
That's sort of what I had with my crypto stuff. I was like, wait, because when it went to 120, it grew to an outsized portion of my liquid net worth. I was like, what? This doesn't make sense. So better to be lucky
I've
than
always
good on the
said
timing there.
a hugely volatile asset like this is great if for portfolio management if you're rebalancing around it, but it's really hard to do.
So here's my game plan for my short-term trade. Again, I'm sure nobody cares, but here's what I'm thinking.
You're
And I'm
catching
allowed
knives.
to-
You're just catching knives all over the place here.
I'm allowed to change my mind. No, I caught 2 knives. I caught 2 pukes. I caught Bitcoin and software. That's it. If it bounces like 72, I'll sell it. If it goes down to 63, I'll probably sell it. And if it pukes again to like down to 50, I will buy and hold more.
So by the way, we didn't
I
even mention this because so much other stuff is going on. Ed Bradford on Twitter is a good follow. Said he showed a chart of silver, and it's spikes and then it crashes. And he said, "This is the craziest market I've ever seen in my life, in 40 years of trading or whatever." And I responded to him. I said, "I didn't even realize silver crashed again today because so much other stuff is crashing." Sean, our research analyst, shared this with me. The 2 worst days in history for silver have both happened in the last 10 days. In history, going back to like 1970. This is the 2 worst days, and everything is a Keynes beauty contest now. Like everything is a derivative of a derivative, and people getting ahead of and ahead of and ahead of, and it just takes things too far, right?
I will say, with all this trade talk, 95% of my liquid net worth is in strategies that we run for clients at Ritholtz Wealth Management. So it's not like I'm day trading my butt off over here. All right, Ben.
Yes. All right. I told you I've taken my hands off the steering wheel more and more as time has gone on for me. I don't like having the brain damage of constantly checking my stocks in crypto, and it's not.
I can't help
worth
it. I'm a maniac.
All right. This chart from Goldman Sachs has been flying around a little bit. They show the cost of home ownership in LA, San Francisco, New York, Boston, DC, Atlanta, and then the rest of the US in 2000 and 2024. Okay. Owning the income ratio in the initial year of home ownership. Okay. When you're a first time home buyer, how expensive is it? What's the ratio of the price to your income? And they've all gone up way, way higher, right? The rest of the US is not that much higher, but some of these big cities, LA and San Fran and New York, and obviously they're not building enough, and these places are still very, people want to be there, right? Here's how I equate this. So my wife's talking about wanting to do a summer trip somewhere this year. I said, why do we have to go anywhere in the summer? Michigan, we have to stay here because it's finally nice. And
You got to hunker down.
But she wants to go to like a national park or something, and we looked at a bunch of places, and it's February right now, and everywhere is already sold out. All these places, you can't find a place to stay in June by booking in February. Because these places are known now. That's what big cities are, I feel like. They're not building more national parks. They're not building more, apparently they're not building more housing in big cities. So I think if you're wanting to buy in a big city and you're a first-time home buyer, unless you have rich parents or you strike the lotto, you're out of luck.
Huge national park guy over here.
Okay, what kind of national parks are we talking?
The national parks. I love all of them. Have I
Okay.
been to more than 4? Probably not. Love them.
Okay.
Here's where I've been. I've been to Bryson Zion. I've been to the Grand Canyon, Yellowstone.
See,
The
Grand Canyon
Tetons.
would be on
Is that
my
a national
list.
park?
So what's the best one you've been to?
All of them.
Okay.
Just love America.
All national parks. Okay.
Although look, my wife is very much not a national park person. Like, there's no way. I mean, and I can't do a solo. Do you want to go to the national park with me? Let's do a little boys trip.
I would love it.
Lace up the boots. Let's go hiking. What do you say?
All right, I'm in. We did have a nice hike together in San Diego last year.
We had a great hike. Are you kidding me? Anyway, all kidding aside, I really do love the outdoors, but probably not in my near future, unfortunately. So, Ben, I don't know if you know this. The Seahawks won the Super Bowl.
I don't know how many people in our inbox reminded us of that fact, that Michael was wrong.
Yeah. You know what? It was all in good fun. I think everybody that texted me, DM'd me, emailed me, it's all good, clean, wholesome, family fun. I put myself out there. That's what we do in the show. I can get dunked on. It's all good. Here's an interesting thought that I had. I mean, the most obvious one is, hey, wait a minute. Markets are efficient? Because when this happened, the Seahawks were the reason why I bet against them.
They were the favorite, right?
They were the favorite, okay?
The market was right.
They were the favorite in week 15. I said, wait a minute, this doesn't make sense. Why are the Seahawks the favorite? Sam Darnold is not a good football player. I mean, that's the stretch. I said, Sam Darnold's not winning a Super Bowl. And the market was right, because the market usually is right, which goes back to the point I made earlier last week. I understand that people feel a certain way about the prediction markets because it's like all speculation and degen behavior and nonsense. And I'm with that, okay? Like, I don't love that aspect of it. But we need more markets in places where markets don't exist. Because when people are just giving their opinion, who cares? There's no skin in the game, right? When think tanks are writing about the demand for this or the price of that, of real giant pools of capital, right? If we made markets and things like that, and money could be allocated more efficiently, that gets me excited.
I get it. Well, I mean, that the financialization of everything, like we're there already. Like this is just our society now.
Because markets, price discovery, it's a thing. Markets work. Markets
Put your money
function
where your
properly.
mouth is, right? Yeah.
Put your money where your mouth is. So ChartKit had an awesome chart showing the net income percentages of the S&P 500 by sector versus the market cap. And wouldn't you know it, Ben, they're not exactly the same, but directionally they all move together. The market
That's a really great chart.
The market is usually right.
So you sent me this Polymarket thing for what price will Bitcoin hit in February. And this is interesting because you talked about like, is stuff priced right or not? This is a really interesting way to play it. So it says you basically pick the price of Bitcoin and it goes from 35,000 to 150,000 in February. Okay. So if you think Bitcoin is going to take off from, what did you say it's at now? 65?
68.
68. If you think it's going to
68!
If you thought it was going to go to 80,000, it's going to take off again. You can buy yes for 20 cents, right? Meaning your upside is 80%, right? It's a huge upside. It's a bigger upside than buying the price.
Here's another thing that I have come around to. And I did say this to Vlad. Think about people that are speculating on Bitcoin using options or some sort of leverage. Hey, guess what? No offense, average degenerate, myself formerly included. When I was buying options on stocks, did I really understand the Greeks? Of course I didn't.
Right.
Of course I didn't. I was like, wait a minute. I bought this call option. Why am I down 16% as soon as I hit enter?
So that's the thing. If you're an options trader, you'd be looking at these markets as well to see where the mispricings are.
Yeah. Yes. I'm thinking more of it from the person that does want to speculate on the future price of an asset. Isn't this a better way to do it if you're going to do it at all?
Right, because you're putting a little amount up for, you're getting implied leverage there.
But it's crystal clear what you're doing.
Right.
You either think the price will be above this or not at a certain date and time.
It is interesting.
It's options for dummies. And I don't mean that disrespectfully, because I was a dummy.
All right, I have a question for you. So Nick Majuli posted this tweet, and he says, why is a $3 million home a status symbol, but a $3 million portfolio isn't? How can someone value looking wealthy over having more financial freedom? Makes zero sense. Obviously, that's correct. I was thinking about this, though.
I love Nick. I think this is a dumb take.
So where I'm in my life, I was thinking about this. Let's say I'm in the Price is Right, and I'm in the Showcase Showdown, and I win both Showcase Showdowns, right? One Showcase Showdown is you get a $3 million portfolio in a brokerage account, free and clear, Vanguard funds, whatever you want. The other Showcase Showdown you win is a $3 million home. And in Michigan, where I live, a $3 million home get you very far. I don't know a $3 million home, obviously. At my stage in life, what would I rather have? A $3 million house or a $3 million portfolio?
Wait, Duncan, poll the audience. Doesn't everybody pick the portfolio?
Yes. I would pick the house. If you gave me, I would pick the house. Where I am today, I would pick the house.
Wow.
I would rather have
Why?
Now, a lot of people would say, you're an idiot.
You are an idiot. You could take $1 million and buy a $3 million house.
The house has insurance. It has upkeep. It has maintenance. It has property taxes. At this stage of my life, and this is not a looking wealthy status symbol thing. I would rather have a very nice home than looking at a $3 million portfolio, seeing my portfolio go up in value brings me no joy at all.
Oh,
I don't get anything from that.
I understand.
I would get way more utility out of a $3 million house. So what would you do? You would take the portfolio?
You're right. Like your opinion of that assessment, I understand. I want to say you're right. I understand it completely.
But I know 90% of people would say you're an idiot. But at this stage of my life, I would take the house.
I think Ben is secretly trying to tell us he has a $3 million portfolio.
No, but I'm saying you get these two things. Wave a magic wand. Which one do you want?
No, I think your point is because you are at a level of success that a $3 million portfolio doesn't do anything more for you than what you already have.
No. This is like my stage in life with kids and like.
No, I'm not. That's okay. That's right. I understand what you're saying.
So like when you see rich people buying up all these properties and stuff, like why would this person need 3 more houses? I totally understand it. I think you get a lot of utility from a very nice house. How's that?
Of course you do. Yeah. If money's no object, like if the people that are buying all those houses can legitimately afford them, and some can, some can't. Yeah, it sounds awesome.
So Duncan, that's a good survey for our channel. I'd like to.
All
see
right, hold on, but let me understand Nick's tweet. Why is a $3 million home a status symbol? How could someone value looking wealthy over have? Oh, I think he's like talking about like an internal. Okay, I understand what you're saying there.
Yeah, but it's also because no one shows off. No one walks around saying, "Hey, I got a $3 million portfolio. Check it out."
Remember that?
See my statements.
Remember, was it a crypto person that had their net worth in their Twitter bio? I think we spoke about this person.
That's possible.
It had to be a crypto person.
It might have been a Tesla investor or something.
Wall Street Journal ranked 9 major U.S. airlines on 7 equally weighted operations metrics to parse out which is the best airline. And number 1, Southwest. I've never flown Southwest.
I did it for the first time this year when you and I went to Vegas a few months ago. Wasn't the greatest experience of my life. I mean, I feel so Southwest and Allegiant are 1 and 2. And they're talking about a lot of it is like lost bags and timing. And those are 2 of the more uncomfortable airlines as far as I'm concerned. I'm surprised Delta's not first on this list. And they were last year. And here's the thing. Southwest and Allegiant are supposed to be like the budget carriers now. I feel like after you add all the fees and stuff, they're not cheap anymore. It used to be like Allegiant, the flights used to be so cheap. They would say like, hey, $150 for a flight. Like if you add on, because you have to pay for your luggage, you have to pay for an overhead, and you have to pay for a seat. Like if you add all the stuff, the add-ons, it's just as expensive as any other flight, but it's not as comfortable. It's like you feel like you're sitting on a piece of cardboard on these flights because they really pack people in.
I'm a big Delta guy. I only fly Delta if I can help it. I put everything on my Delta.
That's my favorite one.
On my Delta Amex card, so you don't pay for bags. On-time arrivals, it's number 1, and it has been for the last 5 years. I've had like 2 bad flight experiences with Delta, which happens. I fly a lot. All right, anyway, this is probably deeply boring for most people. But anyway, I thought that was interesting. Southwest, number 1.
They say on-time arrivals, Delta is best for. I think that makes sense to me. Okay, interesting here. This is from The Economist. One study found that between 1965 and 2012, the amount of time parents in rich countries spent with their children doubled. Now look at this. This shows millennials, Gen X, baby boomers, and silent generation between how many minutes per day they spend with their child on childcare. And we are totally the helicopter generation because we spend way more time with our kids than any other generation. And this tracks with me. With every other parent I know, the dads are so much more involved than they were in previous generations. You think about the silent generation, even the baby boomers, like a lot of times it was like the kids just go do what you want. And I don't know what the ramifications of this are. Like the fact that the parents are so much more involved in the kids' lives now.
So for our 6-year-olds, there was baseball evaluations, okay, for Little League. And a bunch
of an insane thing to do at that age.
Yeah, 6? What?
We've had that too with football, like a football like camp that they're taking notes.
How about the evaluation is just evaluate them during the season, like they're babies, if you have to evaluate them at all. So anyway, there's a lot of like back channeling and make my kid rank a 3 and not a 2. Like, and I'm just thinking like, come on, guys. Are you serious? They're 6. So even like to what end? You want to win a Little League World Series for 6-year-olds? Who gives a shit? Like Literally, who cares? What is wrong with you?
Right.
I
It
get
is.
it if like, fine, they're 10, they're 13. It's fun, it's competitive, you want to win. 6?
This is where, I mean, my parents went to every single one of my games, but they never ever put themselves in and like they never talked to me about my performance. They never like it was, hey, good job, great, you did awesome, or whatever. We're excited for you. They didn't try to like guide my sporting life in some way, and I feel like that is the thing that's changed more than anything. Is like the parents are so uber involved in this stuff now than they were before, and I'm way more than my parents were. So I'm a hypocrite here. But I try to
I
like
do.
back off. I try to like not I try to not ever criticize my kids about what they do in sports and just I always say like do your best and have fun and that's all I care about.
Yeah, it is. It is so much, isn't it? I had the boys over the weekend. So Robin left me. Robin went with her friends to Vegas to see the Backstreet Boys at the Sphere, this is probably the first time that
That
she's
actually
left me.
sounds like a pretty fun girls weekend.
This is probably the first time she left me with the boys. But look at these notes. So she left me like full notes of where I need to be hour by hour with clothes lined up on the counter with Post-it notes. And boy, did I crush the assignment. You should have seen me. Not only did I do that, she came home to a clean house,
Well, it sounds like she made it easy for you to crush the
clean
assignment.
sink. She did. She made it like completely Michael proof because I am not the best with these things. But yeah, I wonder if we're like, sometimes I feel like I'm like not doing enough with my kids. But then, I'm with them. I take them to school every single day. I'm here when they get home.
Right.
I go to their practices. Because like I work a lot. Kobe said to me the other day randomly, like, Daddy, if the Knicks were in the finals, but you had a work call, what would you do? And like part of me felt sad that he asked that.
Yeah.
And I was like, the Knicks, of course, I would never schedule a work call during the Knicks game. He's like, but what if it was like a really important call? Like a really one you couldn't cancel? And I was like, well, I care about you guys and provided for you guys more than I care about the Knicks. So like, obviously I would choose that. But the fact that he said that he's noticing that I'm like working all the time, but fine. I'm still with them. I live in the house with them. I'm with them every
Right.
single day, all time of all days. And our parents weren't like this. Now I grew up in like a divorced household, so it was a little bit different for me, I suppose, maybe. But I think my mom was gone in the morning and like not home when I came home. And I didn't feel like I didn't feel not loved. I was like showered in love growing up.
Oh, it was just normal. It was more normal, and this is more normal.
This feels abnormal.
But this is the way it is now.
I was about to say I feel like I'm roommates with my kids. I guess that's what being a dad is.
But I feel weird about the fact that we can now track them on the phone all the time. Like I know it's helpful. Like, hey, you can see where they are and you can follow them and you can see the stuff they're doing. But to me, like that almost feels like invasive, right? But you can't because when in high school, whenever we wanted to go out and like get in trouble, I would say, hey, Mom, I'm staying at Chris's house. And Chris calls Mom and say, hey, Mom, I'm staying at Ben's house. And that's all we needed to do. We were free for the night to do whatever we wanted. Kids can't do that anymore.
Well, tell me if this rings true to you. Again, my growing up situation was a little bit different with divorced parents, but I feel like all parents and friends are like friends with each other's parents.
Yes.
Was that like that growing up? I don't think it was, but maybe that was just my experience.
Not as much. There's way more competition among the parents. Like the parents feel competitive with each other about the kids. And stuff the kids don't even care about. That's the hardest part is that like, oh, that parent cares, so I have to care. It's like, why?
Parents are a bunch of tryhards, am I right?
Yes.
All right. It's been a minute. It's been a minute since I've spoken on this pod about email etiquette.
Mhm.
Right?
You're a big email etiquette guy.
No infractions, which I think that cements my standing as I'm not an email snob. I'm really not. It's been 18 months. Find me the last time I said anything about somebody's email.
But I'm going to need the AI to get on this, but you've said a lot of stuff over the years.
But it's been a while.
Okay.
I think maybe people have respected my etiquette.
Okay. Yep.
I've trained them through this podcast. All right. So I got an email from somebody that I was maybe doing a favor for. Maybe it was somebody on LinkedIn that I said that I would be happy to speak with them. Because I'm a giver backer, right? You know this. I speak to a lot of people that email me. Give them my number, give me a call. This person sent me a red receipt.
Oh, that's the worst. I hate that. Hate it with a passion. If I see that, I'm like, I'm not responding to you.
To me, and I hate to be so black and white about this because like last week we did people that suck type of list. And I know that there's people that do shitty things that aren't shitty people. I'm sorry. And I don't want to call this person a shitty person. I don't know them, but I kind of do want to say this.
That's desperate.
So it doesn't make you a bad person, but it makes you somebody that I don't want to be around. Okay. It makes you somebody that I don't, I'm having trouble putting into words what a weird personality trait that is. Somebody that sends a red receipt.
That's bad.
Hey, did you see that? Hey, so you said that. Why didn't, dude, come on, get out of here.
Oof.
All right. Somebody emailed us. Michael doesn't know what he's talking about. There's as much caffeine in a Diet Pepsi as there is in an espresso. Okay. First of all, true. I was making it up, talking on the fly. That's what we do here. I've said this over the years many times where I will listen to a podcast like this one tomorrow when it comes out, when you're listening. And I will violently disagree with something that I said 24 hours ago. Why? I'm off the cuff. Okay. I'm wrong all the time. I'm making most of this up. We're having a good time. We're talking. All right. But I wasn't talking about espresso, emailer. I was comparing Diet Pepsi to Starbucks. And here's what ChatGPT said. A 20-ounce bottle of Diet Pepsi contains about 59 milligrams of caffeine. A standard Starbucks Grande brewed coffee, which is what I drink, typically has around 310 to 360 milligrams of coffee. So that's 1/5. Okay. So Ben, in Miami, I want to see you drink a Starbucks coffee. You'll be shaking. You'll be so hopped up.
Can I just have a Red Bull instead? Isn't that easier? A Monster?
Drink a Starbucks. I won't make you drink Starbucks.
They have all these studies that like drinking 1 cup of coffee a day can like help you live longer. Like there's no way that's healthy. That much caffeine in your system. There's no way.
I don't know.
All right, we'll see.
All right, so I had the boys for the weekend, and I thought to myself, I'm gonna get after it.
Did you take them to the movies?
What am I watching Friday? What am I watching Saturday? No, but I did. Kobe won't stop talking about the GOAT movie.
Oh, my kids are going to, because we have a midwinter break. They have so many stupid days off of school. So they have Friday and Monday off of school. So I think my wife's taking them to see it on one of those days.
So Kobe keeps saying this is going to be his favorite movie ever, and I'm trying to teach him a lesson about lowering your expectations. Yeah. He goes, I can't help it. It looks so good. All right. So anyway, so I thought that no movies this weekend. I don't really think there was much playing, but I thought I was going to have myself a movie fiesta. And Ben, I was sleeping by 10 o'clock both nights.
You're tired?
But here's what I did watch. I plowed through the HBO movies. I watched, not the shows. The Pit, the new Game of Thrones show, and Industry are just.
Is the Game of Thrones any good? Is it any
it's so good.
Is it? Okay.
The first 2 episodes were pretty slow, and I was about to throw in the towel. But I heard the third was good. Stick around, so I did, and the fourth was amazing.
Okay, I'll give it a try. I watched. I think someone actually told us about this on the inbox a few months ago. I told you I was looking through all the Apple movies. There's a Tetris movie. There's a movie on Apple called Tetris. It's about the story of how they got the rights to Tetris to go worldwide. Okay, and that sounds like the most boring movie ever. It was actually pretty good. It's got Taron Egerton in it, and basically, I didn't realize this. So here's one thing I learned: Tetris. I've played it a million times, and my wife actually got for Christmas, my son, it looks like a mini video game console of Tetris, and you can play Tetris. So my kids are playing it. I never knew Tet means 4, and so each of the pieces. If you would have asked me how many pieces are in each Tetris piece, because they're built by blocks, each one is built of 4 squares. If you would have told me like the long one, I would have said for sure that's 5 squares. It's got to be 5. They're all built on 4 squares. Okay? I didn't realize this. So they showed the guy who made it, built it in communist Russia in the 1980s. And it was about these video game developers who was going into Russia and having to deal with the KGB to get the rights out of Russia to bring the game worldwide. It's kind of like a spy thing. And at the end, they kind of ramped it up and it was a little unrealistic. But the first hour of the movie or so, just the negotiations with the KGB and the Russian diplomats about trying to get this game out of Russia, it's actually really good. One of the better business movies I've seen in a while. You mentioned the show His and Hers. My wife watched it. Did you finish this show?
His and Hers. Which was this again?
That's the John Bernthal show on Netflix. It's 6 episodes. It's a murder mystery.
Yeah. I finished.
So one of the fun things about these shows is you try to guess the twist because you know there's a twist coming. This show had the most ridiculous twist I've ever. Was it? Me and my wife we were speechless.
It was so dumb.
The twist was so dumb and so bad. Like the first twist is like, oh, the first was that it's the girl and she lost weight. But then, anyway, it was the worst twist I've ever seen. Maybe ever. It was so bad.
Okay, it was so bad. It was borderline comical, right?
Yes.
Like it was like funny.
Like, come on. Are you kidding me?
But so for me, it didn't upset me because A, I'm very understanding that these planes are hard to land. B, it's Netflix. And C, it was only 6 episodes. So I wasn't like fully invested.
And I think it was based on a book. Maybe the book, it was a better translation.
Okay.
But
if it was 10 episodes, I probably would have been upset. Did it bother you? Like, were you like, that was a waste of time?
My wife said, I can't believe we put so much time into that.
But it was only 6 episodes.
Yeah.
I get it. It was comically bad.
So I've been having a hard time getting into new Audible books lately. Like you start one and you're not immediately taken in. You kind of, I'm not into this. I'll come back to it later. But then I started Kitchen Confidential by Anthony Bourdain. And I was never a Bourdain person. I never watched this. I don't watch cooking shows, really. That's not my thing. My wife always loved the cooking channel, not me. My brother gave me the Bourdain book a long time ago, and I just never read it. So I said, you know what? I'm going to listen to this. And he narrates the book. And it felt a little bit like the Cameron Crowe book, where just them telling their own story makes it 10 times better. And I flew through this book. It's just the whole, him coming up in the restaurant world and how restaurants work. And I feel like they could have used him as a consultant on The Bear. Because The Bear, like the chef Carmody takes himself way too seriously. Bourdain took cooking seriously, but he didn't take himself seriously. Like he was very self-aware. And it's so good if you ever worked at a restaurant, like the stuff that he explains about working in a restaurant and the people you encounter and the shady business deals. And it's really, really good. I can see why he was so good at his shows.
Because you know why? You, like me, love a memoir.
Yes, I do.
Okay, so I just started listening to this one.
Okay,
it's called,
I read that one.
Oh, you did?
I read that book last year, yeah.
No shit. How?
I can't remember where it came from. I heard him on a podcast somewhere. It's really good,
Was it
right?
good?
A lot of good stories, yeah.
Okay, so hits, flops, and other illusions. This was served up to me by Audible. So Ed Zwick, and he narrated it, so that's why I bought it. So he directed Glory. He did Legends of the Fall, The Last Samurai, Blood Diamond. Love that movie. Defiance.
He had some Julia Roberts stories in there that do not paint her in the greatest light. I'll put it that way.
I can't wait to listen.
It's a good
All
one.
All right. An hour 20. Is the news going to be slower this week than it was last week? I think so.
I don't know, man. It just keeps coming. Hits just keep coming. Thanks to the production team as always. Daniel, John, Duncan, Nicole, Rob, Graham, who else? Travis. We appreciate it. We have show notes every week on our blog. So wealthofcommonsense.com, irrelevantinvestor.com if you want to see all the charts. If you don't watch it on YouTube, check out Talking Wealth. What else we need to plug? And remember, by Friday, if you want those networking things for future proof, sign up.
That's right.
Animal Spirits at thecompoundnews.com. See you next time.